Matt the Mortgage Guy here. Another Monday night live Q&A, answering any and all questions you have. Before I jump into it, looks like we already have a dozen people or so on. I asked you for questions in advance so I could answer those as people joined, as the questions rolled in. So I want to, be a man of my word, answer those questions that I got in the community tab. And so a couple of great ones came in. This was one that I pinged and saved from Dressalonga. Do you see 3% down offers being accepted in NorCal? Wish I could do more, but we can't save as fast as prices are increasing. I'm in Northern California. I'm in Sacramento. So I feel like I know the market well. I deal with hundreds of clients every single year, probably, thousands of clients to get to hundreds of closings. But what I will tell you is the 3% down is not the issue. Where I think the issue lies is on the more competitive offers, and we're still seeing this, unfortunately. You have to put in there some sort of appraisal gap, meaning you offer $420,000 and you say you're willing to pay up to $20,000 above the appraised value, up to $15,000 above the appraised value, sometimes waiving the appraisal contingency altogether. While some people might think that's crazy, while some people might say that's absurd that you're, stating in a contract that you're willing to pay more than what it appraises for, it's what it takes in a lot of markets, in a lot of neighborhoods where you want to live. And so the 3% down might not be the problem, because I could call on your behalf as your lender and say, hey, listen, I've got this client fully pre-approved. We verified the assets. They've got great income. We're going to be able to close this loan in 21 days. Everything's dialed in. If you don't have extra money on top of the 3% down plus closing costs in order to bridge any appraisal gap that can come up, and it doesn't always come up, but it gives the sellers peace of mind that, hey, if for whatever reason this thing appraises at 405, we don't want to worry about having to go back and renegotiate. We don't have to worry about, this client not being able to perform at a 420 price if it appraises at 405. So I think that that's more of the issue, right? I've got clients that are getting offers accepted with 5 and 10% down. In a lot of cases, they still have the money to make up the difference if it appraises light. And so they're putting 5% down by choice or 10% down by choice, but they might have an extra $30,000, $40,000, $50,000 in the bank, where we can, show that to the list side, explain that to the list side and say, hey, listen, we've got the money to bridge the appraisal gap. The person's choosing to put 5% down because, let's be honest, when money is available at 3%, they're trying to hold on to their capital. They don't want to put 25% down and have all their liquid funds tied up in this home when they could borrow the money at 3%. So that's my 2 cents on that. Hopefully it helps. I know it's hard. Truth be told, puts you at a little bit of a disadvantage. It's hard to save. Home prices continue to go up. People are afraid that mortgage rates will go up next year. So you're not in the ideal position, but keep trying. With a great real estate agent, with a great lender, you're going to be able to find a house where, right now, while it's still super competitive, I'm having clients get more and more offers accepted. If the offer is structured correctly, if, it's a home that maybe doesn't have granite countertops, maybe doesn't have everything completely dialed in, it's going to take a little bit of lipstick on that house to bring it up to, your standard. Maybe you go in there and get an offer accepted on a house like that. Sasha also put a question into us before we started. Wants to know how unemployment factors into income calcs for hourly employees or commission-based employees. If you don't know, hourly employees, commission-based employees, anything that's considered variable income, lender's going to look at least a 2-year history. In most cases, it's 2 full years plus the year to date of whatever current year we're in. And so if you're getting paid on an hourly basis, the lender, in March of 2022 is not just going to look at 2021 and 2020, but also year to date from 2022. The thing that screws it up for these folks, unfortunately, Sasha, is we can't use unemployment in those calculations because it's not something we expect for you to get going forward. Truth be told, you won't get it, right? And so if you had a 2-month gap in employment and you received unemployment, we can't just add that to that grand total and divide. We're just going to take whatever you've made working over those past, let's call it March of 2022. And let's say you've got this 27-month average. First 3 months of 2022, all of 2021, all of 2020. If you only work 24 of those months or 25 of those months, you have to take that number, divide it by 27, and that's generally, what the lender's going to use. There's a couple caveats in there, but that's the gist of it for any sort of variable income. If it's commission-based or it's salary plus commission, you're going to be able to use the salary, then you're going to average the commissions. If it's got, bonus or overtime or anything else that varies, you take the base, that's set, right? That's the same every month. And then you average the variable type income. All right, there was one more question that came in pre-stream from Ava. She wants to know, and this is a really common question. Thanks for posing this question, Ava. This is something that a lot of people are asking right now with home price appreciation, 15, 18% in a lot of markets. If you bought in 2020, chances are, if you have PMI, you're in a position to get it taken off. Now, know that if you bought with FHA, on an FHA loan, the PMI does not fall off. If you bought with a conventional loan, you are able to have the PMI removed, or it should fall off when, like you said, Ava, it reaches 78% of the original loan to value. Now, here's the caveat, a couple caveats. One, a lot of lenders are going to have a minimum amount of time required with mortgage insurance, usually 24 months. So even though the home might be worth $500 and you only owe $383, you can't necessarily get that PMI removed if you're only 13 months into the mortgage. The best thing to do is call the servicer. I literally have in my phone saved the number to any of the servicers from the lenders that I broker loans to, so I can tell the client, call the servicer, ask them, because let's say you're 24 months in or you're 27 months in, you call them. If you haven't reached 78% of the original value, you can still call them and say, hey, listen, do you guys do a drive-by appraisal? Can I order and pay for an appraisal? I know this thing is worth $550 and I only owe $410. I should not be paying mortgage insurance. Every servicer goes about that differently. They all have, different ways that they do it and different ways that they remove mortgage insurance. But call the servicer, ask them what their process is. I recently did this on a personal loan of mine, and got their whole 14-page breakdown on here's how we handle mortgage insurance, here's how you apply to get it removed, here's the steps you got to take, all that good stuff. So that's that. Thanks again for submitting those questions in the community tab. I think I'm gonna do that in the future. It's kind of cool. It's a good way for me to get some questions answered and allow folks some time to pop in here and start firing off with questions. If it's your first time here, welcome. Know that every Monday at 6 p.m. Pacific Standard Time, I go live trying to do my best to answer any and all questions as it relates to mortgage, as it relates to real estate, any questions you might have about the market in general, what I'm seeing as a mortgage broker, what real estate agents are telling me, what type of things might be on the horizon in terms of mortgage guidelines, in terms of what buyers are doing, saying, feeling, hearing, all that stuff. I feel like I got a pretty good finger on the pulse. As a mortgage broker who closes hundreds of deals per year, I am talking to thousands and thousands of consumers. I'm talking to 100 real estate agents every single month. I'm getting points of view from all parts of the country, from every inch and corner of California. Different markets behave differently, but there's certain trends and stuff that we can follow, and we can maybe be in a good position my office to say, hey, this is something you might want to be aware of or look out for. Because like I talked to a buddy of mine about recently, if you're working with somebody who closed their last transaction in August and they're trying to give you advice in December, things have changed quite a bit versus talking to somebody in an office that has closed, 257 deals year to date, whatever the number is, finger on the pulse and closing deals every day for the most part. All right, that's that. Al Bundy, what's up, my man? Good to see you. My buddy Kevin Hawthorne, good to see you as well. Al Bundy, good question here. Last live, I mentioned roof cert. What is that? A roof cert comes up every now and then. You'll be buying a home. You'll get a home inspection. Home inspector will say, a roofer should take a look at this. Or maybe the appraiser calls out, hey, this roof looks like it's on its last legs. It needs a roof certification. A roof certification is a roofing company coming out and saying, this roof we certify has at least 2 years left of, usable life, or whatever I don't know what the verbiage they use is, but they basically have to certify that it's going to be good for at least 2 years. A lender, if the appraiser's usually one, because the lenders are seeing the appraisal, the lender might usually not see the home inspection. But if somebody calls to the lender's attention that the roof might be worse for wear, might be ending its usable life, they're going to call for a roof cert. The underwriter's just going to say a roof cert is required. And that's exactly what it is a roofing company comes out and says, we attest this thing's going to be good for at least 2 years. And if they can't attest to that and you can't get a roof cert, then you're going to have to get repairs done or the lender's not going to close the loan. Just Cruising Mom, thanks for joining from Florida. Are you a broker here in Florida? I have recently parked my license with U Mortgage. We are licensed in 44 states. Florida is one of them. So reach out to me and the team. This is, where'd it go? GreatMortgageBroker.com. You fill out that form. I'm in Florida. I'm looking to buy a home. Connect you with loan officer on my team.
Is there something else I can help with?
This watch just loves to talk to me. I didn't even say anything about trying to talk to Siri. So yeah, go to GreatMortgageBroker.com.
Sure, I understand.
We're happy to help. Watch wants to talk to me. There was another part of your comment there. 807 middle score, can't seem to land a contract. If you're 807 middle score, I'm sure you're doing conventional. I don't know if you're putting 3%, 5%, 10%, 20%, but you should be able to write a really strong offer if you have the ability to shorten your contingencies and close fast, if you have the ability to, bring in money for an appraisal gap, all the things that, like you mentioned, you want to look better or equal to a cash offer. A cash offer is not going to have appraisal contingency. A cash offer is going to be able to have no loan contingency. A cash offer is going to be able to probably, close relatively quickly. So you can do those things with a conventional loan. You have to talk to a mortgage broker you like and trust. We can get you fully pre-approved and ready to roll. And then they have to be able to communicate that to the list side. That's the important piece of it, right? Is even though you can close a loan in 21 days, even though you only need 12 or 14 days for an appraisal, even though you only need a certain number of days for a loan contingency, if it's not communicated correctly, you're not going to be able to submit strong offers, right? And I think that probably starts with your real estate agent. If you have a strong real estate agent who understands the market, who understands how to write an offer, who understands to reach out and say, hey, Miss Jones, on your 123 Main Street listing, what are the important things to your seller? Do they want to close quick? Do they want the highest offer? Do they need free rent back? All these things, I talk to listing agents every single day. And you'd be surprised. A home might get 10 offers. 3 of those offers actually align with what the seller wants. The other 7 just took shots in the dark. just wrote an offer that they thought looked good, right? If your agent is reaching out to the listings side and saying, how do I structure this offer to best fit what your seller is looking for, you're ahead of most right there, right? So make sure they're doing that. And hello from rainy California. If you guys are sunny, I can hear the rain pounding outside. We need it though in California. We've been in a drought for years. We need some good rain. Germain battles. Are rates above 3%, 30-year conventional? They are. If somebody tells you they're below 3%, then they're below 3%, but there's a cost for it, right? Let me pull this up. I've been using this more often lately because people love ask about rates. So you give them what they want, right? If you go to Mortgage News Daily, they've got is that the feedback of myself? Holy guacamole. I hopefully nobody could hear that in that one. Oh, I wonder if it was. I wonder if it was feedback. Well, maybe not. If nobody's complaining about it, I guess we're fine. All right, Jermaine, here we go. Let's share the screen. I'll show you. Mortgage News Daily. They have a daily mortgage rate survey, and this will be the rate without paying points on a pretty straightforward scenario, someone with great credit. And here's where you're at, like today. A 30-year, 3.17, 15-year, 2.52, FHA. That one's probably high. I mean, all of these, I think, as a broker, are probably lower, probably 3 1/8, probably 2.5 or close to 2.375. You got to realize as well that there's going to be some variation in rates between bank, credit union, direct lender, mortgage broker. But this gives you kind of an idea. And then, you'll see advertisements for 30-year 2.625, 30-year for 2.75. Paying a point or a point and a half might make sense in some scenarios. In most scenarios, it doesn't. So just be aware that, there's always, I got a 30-year for 2% right now if you want it. And people that are just like rate, that's all they can see, 2%. Might cost you $24,000 for it, but it's there. So that's that. Between 3 1/8 and 3 1/4 without paying points is generally what you're going to see right now, mid-December 2021. Fading fast. Zeta, thanks for joining. Appreciate your support. The Ask Tech. Oh, that's a good question, Zeta. Really good question. Do you think homeowners insurance will jump up due to all the natural disasters? This will be really area specific and state specific. In California, it definitely has. We had tons and tons of fires, and for rural areas where they're more prone to fires, homeowners insurance has skyrocketed. There's places that are an hour away from Sacramento. People are paying $5,000, $6,000, $7,000 a year for homeowners insurance, which is bonkers, and not even that expensive of houses. I'm talking about, $600,000, $700,000, $800,000 houses with those humongous homeowners insurance premiums. So I think for sure. I mean, insurance companies that's.
I found this on the web.
They're insuring against risk. Why does the watch always try to talk to me? I'm not even saying nothing. Let me take this thing off. So yeah, the short answer is yes. I think that's definitely something that we'll see. Thanks for joining. Yeah, for sure. If we do that in the future, we're asking in advance for people to ask questions. I'm definitely going to jump in there and answer them, because it'd be a bad look if I asked for the questions and then didn't answer them. So no problem. Keep them coming. Joey, Trying to picture what you typed in last week, dude. Joey Gurasi, whatever it is, man. Thanks for joining, man. Good to see you. I like the story you sent me. I got to share it here, man. Joey was looking at different loans, wanted to get an idea what was out there and just kind of poke around for fun. Had a lender ask him to pay for the credit report. Asked him to pony up $40 for a credit report on a pre-approval. Man, it's not a good look for the lender. That's a chintzy lender right there. If they're gonna ask you to pay the $40 credit report, they're not giving away anything for free. All right, Joey. I own my personal residence, plan to rent it out. I also co-own another investment property that earns an excellent margin. Both homes have mortgages. The investment prop is on long-term lease. How would Fannie Freddie calculate rental income on those two properties? I just got the investment property in June, so I don't have income tax. If you bought it in 2021, it's not on taxes yet, we can use 75% of the rental income. For a lot of people, that's better than what we're going to be able to use once it goes on taxes. So I got somebody who bought 6 investment properties in 2021, and he's got leases for them. And he was saying, well, maybe we should wait until we file taxes for 2021 and do this next loan next year. And I told him, probably not. If you've got a CPA that's giving you all the correct write-offs, you're going to look worse on paper once you file taxes versus right now where we just use 75% of the lease agreement, and that's that. So, 75% of the lease agreement. All right, very common question. Thanks for asking it. Does a change of deed from personal name to LLC trigger the due on sale clause? Does this result in reclosing, new appraisal? I've transferred at least 5 properties personally in the last few years from personal name to LLC. No due on sale clause triggered. I've probably dealt with 500 clients that have done the same. And 0 for 500 have triggered a due on sale clause. I've talked to 500 brokers who have dealt with 500 clients. And so, those 250,000, I've heard of 0 triggering a due on sale clause. So I think your chances are 1 in a million that it actually triggers that due on sale clause. I wouldn't worry about it. Inessa, thanks for joining. A gap in alimony due to COVID. So during COVID, alimony payments were stopped or put on hold or not paid. It's a good question. Generally, we want to see the agreement, and then we want to see record of those alimony payments being received. And I don't know if the payments have restarted. I'm not sure how many we would need. 3, 6, 12. I'll look into it for you. Ping me, matt@mtmg.com, and I will make sure I get that answer for you. Anybody who was wondering, I finally bit the bullet. Paid for the MTMG domain. You don't have to type out the whole Matt the Mortgage Guy anymore. Just matt@mtmg.com. Not everybody could use that. Only my favorites. So shoot me an email, Inessa, matt@mtmg.com. We'll get that question answered. And I know that they're going to want those payments back on and being paid. I'm just not sure how many. All those dang Northerners. I'm guessing you're talking about New York, New Jersey, people north of you where you're at in Florida. They're all bringing all the cash down and buying everything up. They can't be going up that much. 10 to 20% every 2 weeks. That's like it's like some Dogecoin prices right there. I've been dealing with listing agents only. That's interesting because usually that's usually a case where they're trying to get your offer accepted over the other ones because they're gonna double end it, get paid on both ends. So the fact that you're dealing with listing agents and still having a hard time, that's tough. Here in Florida, if your roof is new, a 300K home, coastal, they want $5,000 to $7,000 for homeowners insurance. That's crazy. This is wild. $27,000 every weekend for 3 weeks. So it started at $300,000 and 3 weeks later it's like $390,000. Crazy. All right, Johnny Stash, what area are you in? I'm curious. Home prices keep going up. Is there such thing as overpaying? Well, everybody feels like they overpay if they're at the top. I think the question is, are we at the top? Or is there more room to run? Or will things flatten out, but then rates will go up? A lot of questions to answer. I think my best advice to folks is if you're buying something that's your primary residence, how long do you plan on staying there? And if you buy a home as a long-term investment, I think you're relatively safe. And, I just saw it pop up here in Santa Clara County. It's not cheap in Santa Clara County. I'm in Sacramento, so I know. I do a lot of loans in Santa Clara County. But here's the thing. You buy $1 million house, you put 10% down, you've got a fixed rate mortgage for 30 years, your all-in payment is $5,000 a month, whatever the heck it is. It's going to stay the same. You've got a 30-year fixed mortgage. There's probably rentals in Santa Clara that are $4,000, $4,500, $5,000 today and will continue to go up. So in 8 years, it might cost $6,500 to rent there. It might cost $7,000 a month to rent there versus your home that you bought at $1 million. Even if it flattens out, even if it goes down in value, let's say 2 years from now, it's worth $970. You're like, man, I overpaid. I could buy it for $970 now, and I bought it 2 years ago for $1 million. One, maybe when it's worth $970, rates are 4.5%, and that same purchase would result in a payment that's $500 more per month because it's 4.5% versus 3% rate. Or maybe you've paid down $40,000 in principal, and so you're still ahead of buying for $1 million, paying $40,000 down versus buying for $30,000 less 2 years from now. So with all that stuff being considered, I think as a long-term thing, it's hard to lose in housing. People that bought in 06 that thought, I bought a house in 2006. People could have pointed at me and say, you're a complete idiot. The house I bought in 06 is halfway home to getting paid off. It's worth, bought it for $345. Everything around it was selling for $180 5 years later in 2011. Now I think it's probably worth $550. So what's that as a percentage? Like it's up 60% in value and it's halfway paid off. I mean, was I looking like an idiot 5 years after purchase? Probably. Am I looking like an idiot 15 years after purchase? Probably not. So I think that's my answer, and I'm sticking to it. Real estate as a long-term investment has always proven to be a good investment, especially when you've got 30-year fixed rate money. You can buy that $1 million house in Santa Clara, put $100,000 down. You could buy $1 million house and put 5% down. The county limits in Santa Clara are now $970,000, $800,000. I probably wouldn't recommend it, but you could buy $1 million house and put 3% down if you're a first-time home buyer. So your skin in the game versus the banks is very minimal. What if it goes up 30% in the next 10 years? I mean, that's like, we've seen 30% in 2 years. I'm talking about 30% over the next 10 or the next whole decade. Like flattening, only 6% this year, then maybe only 3%, then maybe a flat year, maybe a negative 5%, maybe a 6%. Like really steady appreciation. 30% over 10 years. That's $300,000 in appreciation. And over those 10 years, you'll pay the mortgage down from $900 to, call it $625. You'll have something worth $1.3 that you owe $625 on. $675,000 in net worth. And you put 3 or 5% down. You were $30,000 or $50,000 into it. You got to live somewhere. You got to pay for housing somewhere. All right. End of rant. Yeah, California appreciation, Michelle. It's a magical thing. Man, I know people that, handful of properties are controlling millions in real estate. And when you see 15% appreciation, you own $3 million in real estate, you got $500,000 in net worth real quick. Real quick. All right. Inessa's moving down to Florida. She's going to talk to Just Cruising Mom, get some information on that market. High auto insurance, high homeowners insurance, but that's the sunshine tax. She's going to get a Tesla, drive it down there with her Tesla insurance. All right. Bunch of Florida talk, bunch of insurance talk. A lot of folks are always wondering what's new in mortgage. I just recorded a video today talking about inflation, all the talk about how the Fed missed a huge miss in terms of them talking about inflation being transitory, right? It's proving to not be transitory. Inflation's real. Inflation's here. How's that going to affect mortgage rates and real estate in 2022? Tomorrow, mid-afternoon, I did about a 10-minute video on that. Talked about the relationship between rates and inflation, how the Fed uses interest rates to lever inflation up or down, depending on where it's at and what they want it to do in the future. So hopefully that one's got some value in it, because it'll be an interesting week this week. It'll be interesting to see what comes of the Fed meeting. Tomorrow, December 14th, the Fed is meeting. They do a 2-day meeting, and then on the second day, they, end it by making a statement. So it's always, all eyes on our buddy Powell on the Wednesday when the Fed statement is coming out. Want to know what he's saying about what they're going to do to tame inflation in the future, want to know what they're going to do with their purchase of mortgage-backed securities with the, Fed funds rate in 2022. Are they going to tick it up at 0.5% at a time and take it off of 0 to 0.5 to 1% within 3 months? Whatever he says on Wednesday is going to have an effect on the mortgage market, mortgage interest rates, for better or for worse. We shall see. Any new programs for first-time home buyers? Not yet. I mean, it's going to be something that will be talked about. The administration talks about wanting to do stuff for first-time home buyers, but programs for first-time buyers isn't what's going to help first-time home buyers. There's got to be something, what's a good analogy? You got to get at the root of the problem. And the root of the problem is supply versus demand, and not enough homes being built at affordable prices. And, all the red tape in California is a prime example of, like, when you make it super restrictive and super expensive to build homes are going to be expensive. And when there's a lack of inventory and it's expensive and restrictive to build, no one's going to build. It's going to cause a further strain on inventory. And that strain on inventory makes it to where there's less homes for more people, and it drives prices up. So, creating a program that says, oh, we realize it's hard, let's give you 3% towards your down payment so you don't have to come up with a down payment, is only going to make it harder. It's only going to drive prices even higher, when most would argue they're higher than is reachable, feasible for a lot of folks, in that bucket of first-time buyer. So that's my 2 cents on that. You inject a first-time home buyer program and that's all, you're doing more harm than good. BOJIM. Wells Fargo put a hold on my HELOC when I went into forbearance October of 2020. Now, out of forbearance and loan modification finally approved, I have to provide proof of income and tax docs to reinstate HELOC. I mean, it makes sense to me. It doesn't really surprise me. I would be the first to bash Wells Fargo for any good reason, because of a lot of their business practices. But in this case, if I'm the one holding the home equity line of credit and I'm the one lending you money, I'm doing the same thing. If you're in forbearance and, putting the mortgage payments on hold, I don't think being able to draw from a home equity line of credit makes a lot of sense. And coming out of forbearance and modification in place, sure, we could reinstate your HELOC. Let's just get new documents to prove your quote unquote ability to repay. It all makes sense to me. As much as I'd love to not agree with Wells Fargo, because they're opening fake accounts and doing all kinds of shady stuff, in this case, I'm going to side with them. Zeta, this is a funny story. I go to a lot of real estate investor meetings, so I see this too, and I agree, right? It's almost impossible to buy cheap houses to flip. Everything's so expensive. And, he's flipping a mobile home. I cannot believe mobile homes that were selling for $30,000 and $40,000. I've seen sell for $140,000. This is a real thing. People are flipping mobile homes. And, it's probably a good idea. Mobile homes might be something that people turn to for housing when, affordable housing inventory starts to shrink. All right. Some more Florida advice. If anybody's moving to Florida, just cruising mom, she got the info. East Coast. They have ocean breezes. That's good to know. Yeah, tame the future. All right, James. Does a hard money or private money loan count towards DTI? I'm trying to keep my DTI low by not using my HELOC to do a BRRRR. When I refi out, I'm not sure what a lender sees. Well, it depends. Hard money or private money should and would put a lien on the property so that they have some recourse should you try to skip town. And so if they put a lien on the property, that's going to show up on the preliminary title report, and the lender's going to ask, how much is this lien? What's the monthly payment? They're going to ask for all that information. Sometimes there's private money where they just say, listen, James, you're my boy. I'll lend you $400,000 at 5%. They won't tax the property. And in that case, it doesn't show up as a lien on title. It doesn't show up on credit. On credit, and you're good. But my guess is most hard money lenders, most private lenders are going to put that lien, and that's going to show up and going to have to take into account whatever that payment is. A lot of those are interest only or whatever it is, but lender's going to want to know what are the terms, how much you're paying per month. Good question, Josh. This is something I think will benefit lots of folks who are curious about. You're taking a loan from your 401k, help with your down payment and closing costs. Would the loan be used in my DTI ratio? It's not. I remember somebody coming to me and being like, Matt, why is this not factored in? Like, I'm going to borrow it, and then I made, I checked the box, and I'm going to pay my 401k back $400 a month until I'm paid back. The reason it doesn't hit your debt to income ratio is because you're borrowing from yourself. If you borrow, let's say it's $20,000, and you're paying it back $400 per month, $200 per pay period or something like that. If you don't pay it back and you leave that job, or you just don't pay it back, whatever, something happens, you don't pay it back, that money just gets taken out of your 401k. It's not, it's a loan to yourself. So if you default on yourself, you just have less money in the 401k, right? So I promise you, I've looked into it, and people will be like, that doesn't sound right. You've got that payment. That payment is something you're paying every month, not factored into your debt to income ratio. I promise. 401k DTI. I said I promise, so I always double check myself. I saw a total trash mobile home today for $259. Holy guacamole. How easy is it for a lender to re-pull credit in the mortgage approval process? Your teammate Brandon. My dude Brandon's the man. He pulled your wife's credit. Oh, 739. Yeah. If you get to a 740, you can do a repull. If he gives you any grief about a repull, tell him to put it on my tab. I got you. I gotta do a little picture for Brandon. Let him know he's doing a good job. There we go. So yeah, this happens all the time. Credit improves. You pay a few debts down because your Home Depot card's at 900. Pay it down to 100. Especially for my boy Joey, have him repull to see. Not going to be a huge difference in rate, but it's something, right? Yeah, I believe it, Zeta. Older, cheap mobile homes are harder to find because people are, that's the thing is people aren't moving as much. There's not as much turnover. That's a problem with single families. It's a problem with mobile homes. It's a problem everywhere. It used to be, I can't remember the exact number, but I think it's over 10 years now, how long people stay in a house before they move. There's a term for it, like not turnover rate, but whatever the term is, where it used to be 5 or 6 years average in a house. It's over 10 now, I think. G. Glover, can a non-borrowing spouse help increase your loan amount? The term non-borrowing spouse is like on an FHA loan where you're applying for a loan, your spouse isn't going to be on there, but we have to pull the non-borrowing spouse's credit report. In that case, we use their debts, but we don't use their income. So they're not going to help increase your loan amount because we're not using their income. We're just using the debts. We're actually lowering your purchasing power or buying power, whatever you want to call it. If you want to increase your loan amount, if you want to borrow more, you have to take them from a non-borrowing spouse to a borrowing spouse and put them on the loan. No sound? Is that me? Or is that G. Glover? Hopefully I've got some sound. You guys let me know if my sound's good. G. Glover might have to go re-listen. That'd be weird. If my mic just stopped working. Hello, hello, hello. My sound working? All right, G. Glover, you're back. Cool. You might have to rewind to hear my answer to your non-borrowing spouse question, but we answered it. Yeah, mobile home is a different type of financing anyway. Just cruising mom. It's a chattel loan. I don't know what that word means, but if it's a mobile home in the park, it's a totally different type of financing. Can I get a HELOC with the appraisal from 30 days ago? That depends on the lender. Home equity lines of credit are generally small bank type deals. They probably want their own appraisal, but certainly pitch it to them. Ask them if you can use that appraisal you got for that. James Petrie. For sure. We got you out of state. Let me pull up this link for out of state stuff. Banner. GreatMortgageBroker.com. You're probably going to be dealing with Brandon as well, or maybe my buddy Bo. But go to GreatMortgageBroker.com, fill it out, Indiana, name, what you're looking to do. In some of these states where homes are less expensive, I think we got like $100K min in place, or maybe 125. But as long as the loan is within the parameters, we can hook you up in Indiana. So, yep. Yeah, Indiana, we're licensed in for sure. Holy moly. Just cruising. Talking about mobile homes, almost 300,000. There's some people that are like, man, in my town, you can get a single family. It's beautiful for 300,000. Yeah, if it's a piece of owned land and that mobile home or that manufactured home is on concrete foundation, you can get conventional financing. For this one, built in 71, I don't think you can get conventional financing. I think it's got to be 76 or newer. 496 square feet for 275. Bonkers. All right, Richard, here's a good question. Self-employed borrower, I can tell by the question being asked, he's asking why are audited P&Ls needed? Since COVID, lenders have gotten more and more strict with self-employed borrowers. And the reason why they ask for audited P&Ls, audited profit and loss statement, is because they want to know that your business is back, your business is booming. In 2020, it was needed especially because you might have had a nice 18 and 19, and then 20 when COVID hit, your business could be totally shut down. Your business could have fallen off a cliff income-wise. And so October of 2020, they want to see what your year-to-date profit and loss looks like to make sure that you're still in business on pace to do what you did in 2019. In 2021, to me, it seems a little bit overkill, right? To say, like, if you had a great 2020, you obviously survived COVID, but they want to see 2021 P&L. They want to see the 2020 taxes. They want to see 2019 taxes in a lot of cases. And so it's just a way for a lender to have some reassurance that your business is still operating, thriving, on pace to do as much business as they did the year prior. All over the country, Zita. 44 or 45 states. In the 4 or 5 states I'm not in, I've got the best connections to the best brokers in the country. Yeah, you're right. Pre-76, it's impossible to get financing. I wonder, is there a lot of that stuff in Florida? A lot of manufactured homes, mobile homes that are old? They got to do some new building in Florida, it sounds like. You got people that want to go there, live in that sunshine. All right. I don't want to keep you on it. I'm going to answer a few more, then I'm going to get out of here. I put in an hour's work today. Yeah, I guess the seniors like it. All right, I got to give a good piece of advice here. My realtor told me to use local mortgage company. Good job by the realtor. B of A gave me a better interest rate. You got to be able to find a local mortgage broker that's better than B of A. For sure. For sure. Like, we beat B of A all day, every day. In any market where it's competitive, Bank of America and their process, they might do some things well at Bank of America. Mortgage loans is not one of them. If you're trying to submit an offer and close in 22 days and release contingencies, I would be, well, forget what I think. Submit an offer with a Bank of America pre-approval letter. And you might not be there when the listing agent is reviewing offers, but it's going to go something like this. First offer, 422. Mortgage broker can close in 22 days. Looks good. Next offer, 410, lower, but it's cash, then close in 17 days. Here's one for 425. Bank of America pre-approval. They say they can close in 30. I know they can't. We'll use this for scratch paper. Next offer, considered. Last offer, Wells Fargo. Yeah, right. I mean, that's what's happening in the real world is like a bank pre-approval, a Rocket Mortgage pre-approval. Agents know how these businesses operate, and it's going to get your offer either thrown in the trash or put in the bottom of the pile. One of the two. If you're in a market that's competitive at all, and most markets are, you don't want to put yourself at that competitive disadvantage. Just my 2 cents. All right, filling out the info now. We're going to get you hooked up in Florida. Going to get you accepted. Joey, New Year's resolution list. I mean, New Year's resolution or goals for the channel, for the business? I know I just talked to somebody on the U Mortgage team who's helping with channel content and all that stuff. I'm trying to add as much value as possible. I literally just sent this. We're going to have 11,000 subscribers by the end of the year, 15,000 by the end of Q1, 25,000 by the end of Q2, 40,000 by the end of Q3, 60,000 by the end of 2022. That's what we're going to do on the channel. More people equals more value being given, more education being thrown at folks. That's the channel. The business, we're going to close 200 million, which is probably 500 closings. It's a lot. It's a lot of people. The crazy part is that's just California, and I separate that from the other business because the other business, I have separate teams closing those other deals for now. My goal with going nationwide is not just to do more business and create more dollars. We'll continue to serve people at a super high level. So I've let teams who I know can handle those at a high level take all those deals on. And we've got lead intake that's specific to like, how do we make sure those people get taken care of? So that's the goals. 60,000 subscribers by the end of 2022, Joey, and 200 million in closed loan production just in California by the end of 2022. Thanks for asking, brother. That's a quick overview. Why does it take forever to get UWM to transfer the appraisal report to another lender? Should be a fairly straightforward process with just requesting it to get transferred and then transferring it over. Might be an issue on the other lenders receiving of the appraisal. Because it's not a super difficult process. It might take a couple of days. You got to get like the XML file, and I don't know. I'm not in the mechanics of the loan anymore, but from what I know and see and hear, it's like 3 different parts of the report that need to be transferred over. So not sure what the holdup is, but if it's a refinance and you're transferring it over to another lender, I don't know. Best of luck to you. Just mom. Thank you. Mom? If I applied for a HELOC, will that impact my ability to get a loan? We're going to have to take that home equity line of credit payment into account for your debt to income ratio. So will it impact your ability to get a loan? Yes. And, it's the same thing as if you bought a car. We're going to factor in that $500 a month payment. And, if you still qualify with that payment, you're fine. But probably something you want to talk to your loan officer about to make sure that you're not taking yourself above the debt to income ratio, that you qualify at. All right. The people who submit offers with an FHA loan typically ask for more repairs. Another question, how to know how much to request the seller to fix? Are there any common things to consider? In a market like we're in where it's super competitive, you want to you want to not necessarily, getting an FHA offer accepted is going to be hard. Like those, it's just the truth of the matter. It's the reality of the market. If you're submitting an offer on a home that's got multiple offers, 5, 6, 8 offers, conventional is just going to be something that the seller considers ahead of FHA. I hate to say it out loud, but it's the truth. And so once you do that, you and your agent can discuss what is reasonable to ask for repairs. And, what you ask for and what you don't ask for, regardless of what type of loan program you're getting, is something that, that's a real estate agent conversation. If there's something that has to be repaired because the lender called out, hey, listen, these stairs are a health hazard, or this dry rot needs to be fixed because it's, a health issue. That's different. But if you're just like, what can I or should I ask for? You can get in contract on a home. You can ask for $30,000 in repairs. You can ask for whatever you want. But if the listing agent laughs or says, no, go ahead and cancel, we'll find another buyer. In a lot of markets, sellers got a lot of leverage right now. There you go. Thank you, Zeta. Smash the like button. I never checked in, but what do we got? Oh, only 14 likes. That's all right. You guys can catch me. You can cash me outside with the likes maybe next time. Yeah, I wish you all the best getting a seller to fix anything. Yeah, sellers aren't necessarily fixing a lot right now. Here you go, Lisa. Matt at mtmg.com. Shoot me a message. Happy to help. This is a great question, Josh. What's your take on builder's lender versus, a broker? I'm a broker. This is such a good question. I've made multiple videos on it. If you go to my channel and you search builder's lender, I've got a video from like a year ago. Do I have to use the builder's lender? And basically what the video says is they want you to get pre-approved with their lender. Understandable. They're going to offer incentives sometimes. Okay, cool. When you put them side by side, what I've seen lately is as those incentives have decreased from $7,500 to $5,000 to $4,000 to $2,500, you take a $2,500 incentive when the builder's lender is charging you $5,000 more than I would as a broker. I'm still better by $2,500. No matter how many smoke and mirrors or how well it's presented, where it's like, no, listen, you've got a $2,500 incentive with us. Well, you go to Kohl's and the sweater is $100 and it's got a 30% discount and now it's $70, but you can buy it on Amazon for $50. It's still cheaper on Amazon. Just because you got $30 off at Kohl's doesn't mean it's better, right? And so same thing with the builder's lender. The only way to really tell, Josh, because in some cases it's like if our loans are side by side the same and then they're given a $2,500 incentive, I'll tell you to use them. And I've done that plenty of times. But you got to look at them side by side. The builders are dirty AF in a lot of cases. Not only do they offer incentives, I had one lately where I'm like, okay, I can kill them. I'm better by $3,000 with that incentive. We sent out the disclosures on a borrower I've done a loan with in the past. And on the fees that we got from title, we saw like a marketing fee of $5,000. Like, what is that? Oh, if you don't use our lender, you got to pay a marketing fee. What? Dirty. That's a video I made recently because that was fucking dirty. I was beware of builder financing. That's the name of that video. Why has it got a 1 in the title? Yeah. Beware of builder financing is the one I made recently, where I just told the story. It's an interesting one. Go check it out. When a loan is approved, typically how long does it take to close? I mean, on a very vanilla deal, we're getting loans clear to close in 15, 17 days. On a deal that's more complicated, on a deal where the buyer has a trouble tying their shoes and takes 11 days to get their bank statements to us, or it takes them 9 days to write a letter of explanation and get back to us on things we're asking for, then it might take 30 or 35 days. But I would say on most contracts that are being written in California, we're writing 24, 25-day contracts. Majority of that timeline is to account for it taking 14 or 15 days to get an appraisal back, and a few days because buyers are busy. It takes them a few days to get stuff back when it's asked for by the lender. So we gotta give you a little breathing room. We can't be too hard on you. Okay, you have a great question. If we ask for a pre-approval letter, can you show a letter for more than the purchase price, of course, qualified for? Realtors expect it to be more than asking. Oh, yeah. If you have a pre-approval letter, show a letter for more. Yeah, I mean, you can, it can be a $400,000 home. You could show a $500,000 pre-approval and write the offer for $435,000. More's never a big deal. But if the house is listed at $400,000, you have a pre-approval for $400,000, you try to write at $435,000, they're going to ask you, can you go to $435,000? And they're going to call me and say, we got a letter for $400,000. They wrote $435,000. The realtor was either drunk or not paying attention. Can they actually go to $435,000? Then I'll say, no chance. We got them pre-approved at $400,000. That was the absolute max. Or, oh, yeah. They can go to $435,000, no problem. They initially asked for $400,000. We gave them the letter at $400,000, but they can go higher. Inessa. Land purchase with construction. There's actually a one-time close. AFR is a lender that does it. I've got somebody at UMortgage who specializes in those. Yeah, it's basically called a one-time close. It's a land purchase, it's a construction loan, and you close it all at once. This is high. Investment loan. It depends though on. It depends on the loan amount. I'll put in here like purchase $400,000. Put 25% down. 95826. Purchase investment. I'll show you. We haven't done a lot of these tonight. I'll price a couple lenders. I'll take out the adjustable rates, just the 30-year fixed. 4,375 with half a point sounds gnarly. Let me show you something. I got 399 with no points. I got 3,875 with a quarter point. Take a look-see-loo right here. But see, if you're buying, if this 188 is your loan amount, what is it? 20% down, 25% down? The smaller loan amounts are more expensive, mostly because No, 188. 20. See, that's the other problem. 20% is much worse than 25. 25%, which on that size loan amount is probably only an extra 10 grand. Can be a lot better terms. Yeah, 4.375 with half a point is actually about right for that size loan amount and 20% down. Whew. Yeah, there's a big adjustment. It's light years better to put 25% down. A lot of investors put down 25% for that exact reason. Beware of new home builders, period. Have a good real estate attorney look it over everything. Yeah, I mean, I can't disagree. A year and a half to start? Wow. To make sure my numbers are correct, are the trailing 12 financials of a seller able to be looked at by the buyer on a multifamily property? Yes. The only problem, Josh, is that some just don't have it. And no matter how much you want it, like I bought a couple fourplexes in 2019. This seller had no idea. You know, so we can ask for the trailing 12 all we want. Yes, for sure. 25% down. The numbers are going to look a lot better because you're going to pay a half a point, which is $1,000 for 4.375. And if you put down that 5% more, what is it's like a 235 purchase. I backed into that 188 loan amount like that by just doing some quick math. Not as dumb as I look. All right, let's go to 75%. 75% loan to value. So now 176,250. It's only another 11 grand. 11,750. You're paying 1,000 less in points. And now for that same half a point, you can go to 3.875. Or you can have a 4% with no points. There we go. There's the ticket. No points at 4%. So saving $1,000 on points, and you know your payment's probably going down $80 or $90 a month. Yeah, 25% down. If you purchase a rental before your primary, will your rental property hurt your debt to income ratio? Yes. And here's the thing people don't understand is your rental, if it's renting for $2,000 and you're like, yeah, but my mortgage is only $1,600, that helps me. Not really how it works. Because your income's $5,000. You've got $2,000 in rent. You can only use 75% of that rent until it's on the taxes. Then when it shows up on the taxes, it's probably less. But let's just say it hasn't hit taxes yet. So $5,000 plus $1,500. Now you're $6,500 on the rent side. You've got a $1,600 mortgage payment. You got no other debt. You've got to fit that $1,600 payment plus the new mortgage payment within a reasonable debt to income ratio on that $6,500. So we'll do 6,500 times 45%, 29.25. You can only get approved for like a $1,325 mortgage. So yeah. All right, Josh Martin. Explain points and how they work. This is the last one. last one after this quick one, because somebody asked about this and I might have skipped the next one. Rates, the end of spring 2022. When's the end of spring? Like Q2? 3.625, 30-year fixed. Final answer. How do points work? All right. 25% down on this deal we were talking about for somebody else. Let me show you how points work. Dun, 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 dun. Share screen. I got to make this bigger. All right, let me zoom in. Control ++. Everybody see this? This is an investment property. This is 4%. 0.114. I probably got to zoom in some more. So these are the points. Bear with me here. I'm going to show you a live look. Okay. You got 4%. You got 0.114 points. A $200 cost for 4%. $841 payment. You want to go to 3.875? 0.511. That's like a half a point. And Josh, what this 0.5115 means, this loan amount is, I believe, $176,250. Because for somebody else, we did a $235 purchase price with 25% down. So $176,250. If you multiply that by 0.511%, 1/2 of 1%, that's where you get this $900 cost. So you pay $900 in quote unquote points for 3.875, and you've got an $829 payment, right? Then you want 3.75, it's 0.938, almost 1 point. 1 point equals 1% of the loan amount. So $176,250, 1 point would be $1,762.50. This is almost a point. This is $1,652. It's 0.938 points. And the payment is $816. You've got all these rates available. Look, you could buy it all the way down to 2.125 for the low price of 8.4 points. Never, ever, ever would you do that, right? You'd pay $14,000 in points up front to get this payment down to $663 a month. The sweet spot is probably somewhere near this 0 point range. The funny part here is, look, like 4.125 is more expensive than 4%. Like the lender's almost steering you to 4%. This is the one that makes the most sense. For another $74, you get 3.99. It just looks a little better, feels a little better. You only save $1 a month. But yeah, as the rate gets better, you pay points, and that's what it is right here, discount points, to get the rate lower and the payment lower. As you go up in rate, there's a negative number there. That's credit, a 1/4 point in credit, 1/2 point in credit, almost a point in credit. If you took the 4.49, you'd get $1,600 in credit to pay for costs. If you went this other way and you wanted to pay a point to get 3.75, $1,652 in cost to get that, and the $816 payment. What you got to do when you're looking at points and trying to figure out whether it makes sense or not is, okay, 4%, my payment's $841 and $200 cost. Do I want to pay an extra $1,400 to lower the payment by $25? You can do the math. 1,400 divided by 25, 56-month break even. Are you going to keep this property for more than 5 years? Do you value $1,400 today more than $25 a month for as long as you keep this property? All these are good questions, a question you should be asking. All right. ending it there. Hope that helped, Josh. Everybody have a great night. I appreciate you watching. As always, if you've got more questions, I've got more answers. Continue to follow up. Like, comment, share, subscribe, invite your friends. Do all the things. I'm going to continue to make videos. You guys continue to show up, continue to ask good questions. I'm happy to help. If there's anything I haven't done, if there's a video you want to see, please, please, please ping me anywhere on social. Let me know, hey, Matt, I'd love to hear about the price of eggs in Shanghai or whatever the heck it is that you want to hear about, right? All right. Until next time, we gonna see.